Central bankers sure are a patient lot these days, aren't they? It was only a couple months ago they kept saying, get ready for higher borrowing costs, and now they're patient. They're waiting, they're watching, they're holding the line. That clearly has an effect on the markets. So let's dig deeper into that now. Diana Avigdor, portfolio manager and head of trading with Barometer Capital Management, joins us now from the TSX. Good to see you, Diana.
Thank you very much. Thanks for having me.
So this softer, gentler tone on both sides of the border. We should start with our own country. We had Governor Polas today, although he still thinks he's going to get to a higher rate than we're at right now, but he is staying the course. How does this all play out for us?
Trading desks, traders think that, well, they're a little disappointed he wasn't dovish enough with everything that he said, saying that rate hikes he'll be taking it slower, and so maybe in the first half of the year there will be no rate hikes. So that maybe is dovish, but the fact that he talked about having to get to neutral rate at some point, you can see that in the Canadian dollar was up, rallied 70 beeps right after that. Flip side, the U.S. dollar, when you flip that to Fed Chairman Powell, his dovishness actually showed up in the currency market as a weakness in the U.S. dollar. So you can kind of see how the market is taking the central banker's words by looking at how the currency is trading. And in Canada's case, our currency actually strengthened.
Now, when we talk about our own central bank, obviously there's clear and immediate reaction in our currency. But when we talk about the U.S. Federal Reserve, there is a reaction in so many asset classes. The entire global investment community watches the Fed like a hawk. Jerome Powell, very gentle language last week. And today we had at least 4 regional Fed chiefs all coming out and singing pretty much the same tune that we saw in the minutes. Don't worry, we're going to take it easy. We're not going to rush anything. How does this change the game for us in 2019 when it comes to trading stocks?
It is shocking to me how it's taken 2 or 3 months to go from new highs, positive economic growth, and Powell that was so hawkish in the markets being able to absorb rate hikes because of the growth narrative to 2 weeks ago we were going into a recession, and even the Fed chair going from a very positive and strong language on rates and raising rates to finally last Friday when he was on the panel with Mr. Bernanke and a previous chair, speaking so softly and friendly to the stock market, which is what the market kind of wanted to hear. All the market wanted to hear is to make sure that the Fed chair or that the Fed is data dependent, which they should be anyway all the time. But the rally or the lack of pressure on the market actually started on Boxing Day. That was the first day that the market actually rallied in something like 65 days. We had 20.4% sell-off in something like 65 days. That's extremely fast. This is everybody going in the same direction at the same time, running through the same door. So it's very volatile. So when you have, to your question, when you have a Fed chair backing what people fear, which is a rate hike, a balance sheet reduction, and a slowing in earnings, you want to make sure that everything is being held in adult hands and is being watched.
All right, so let's talk about our money being held in adult hands. What are you doing with the cash? I know a lot of people are trying to figure out, are we getting a rally in a bear market, or have we put the worst behind us and good times are ahead? How are you positioning yourself?
So I want to talk about 2 things. I want to take the opportunity to just remind people that the markets have gotten to be more volatile and faster. Information flows through into prices and stock markets much faster than in the past. Why am I saying that? Why is that important? It's important because it can throw you off your long-term balance very quickly. I know a lot of people that got very scared through the sell-off. Now, then you have passive money and active money. We're active money. What happens to us is as stocks move down, we get thrown off our positions and we go more and more into cash. So as these 3 months occurred, at some point we were 20 to 30% cash equivalents in some of our funds, some even 40%. As the markets come up, you step in, you buy as things move up. Now this is active management. So there's 2 worlds out there. Do you want to take advantage of these moves, and get yourself an active manager, or if you trade your own account, you make sure that you sell on the way down and buy on the way up. You step in gradually. You don't have to go and try and pick bottoms and tops. So from our perspective, we have now started to deploy some of that cash, but not fully. There's some congestion. It's not going to happen all at once. It took some time to get down here. There's going to be some fear. A lot of people are underinvested and fearful. So we're going to be watching and stepping in a step-ladder fashion.
One of the big questions, of course, are can the Canadian energy stocks make us some money this year, considering how they've been beaten down? Do you have any hope for that space?
I do, and I've had hope for that space somewhat in the halfway of the sell-off. So I was disappointed with how things were going in the last month. Look, it's really, you really got to have a strong stomach to handle or be able to take the volatility of the oil market too. We've gone from 80 to 60 no stop, and then from 60 to 45 no stop. There was no love. There's no interest. There was no interest in any of the energy stocks. And now we're up how much from the lows? Now we're up over 10% from the lows, with oil up 5% only today. Sure, fundamentally things have changed. The inventory situation is different. We have Saudi Arabia talking about cutting production and so forth. We also have no positioning, no shorts, no longs, so the markets can move fluidly in the direction that they're being catapulted to. So yes, if there is economic growth and if the inventory situation stays balanced, I think that there is some opportunity in this market. Plus, it's been sold down so much.
All right, Diana, as always, thanks for your insight.
Thank you very much for having me.
It's Diana Avigdor, Portfolio Manager and Head of Trading with Barometer Capital Management.